This was always going to be a big week for financial markets, and events earlier in the week around the US banking system once more did throw an additional spanner in the works. But the two key events for this week were always going to be the Federal Reserve on Wednesday and the US jobs report on Friday. One of those is now out the way. The Federal Reserve met on Tuesday and Wednesday. They raised interest rates by 25 basis points, which was in line with market expectations. But there was one big change to the statement, which many did anticipate, but it was no guarantee. There was an expectation that we were going to see the drop of the commitment to raising interest rates further at the upcoming meetings. And while they weren't necessarily explicit in saying that there won't be any further rate hikes, the change in the language certainly alludes to that. Rather than insisting that some additional policy firming may be appropriate, the Fed opted to say that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In other words, while they don't want to say that the tightening cycle has ended, they have laid out a number of reasons why they believe that they may not need to raise interest rates anymore going forward. And I think the economic data and events over the next couple of months is going to give them plenty of reasons to pause the tightening cycle and potentially, over the few months that follow, consider actually cutting interest rates in line with what markets are expecting. As it stands, markets now expect that the next rate move will be a cut, with further cuts to follow towards the back end of the year, totaling around 75 basis points over the course of 2023. That may change over the course of the following months. There's still a lot of more economic data to come. There's still a lot more events in the banking system to come, I'm sure, given what we've seen already over the course of this week. And that may change the view of both the Fed and those in the markets. But at this point in time, rate cuts are likely to be the next moves from the Federal Reserve in the latter part of this year. Speaking of further data to come, on Friday, we've got the US jobs report, and that could be influential in determining how the Fed does pivot over the course of the next few meetings. We are expecting to see some weakness in the jobs report on Friday, but I expect we're going to see much more of that over the coming months, which will ultimately convince the Fed to start cutting interest rates either late in the summer or early in the autumn. For Friday, we're expecting 179,000 jobs to be added, but that could be a little bit weaker again. Average hourly earnings are expected to come in around 4.2%, continuing that move back towards the kinds of levels that we were seeing before the pandemic. And unemployment is expected to remain at 3.5%, but again, over the coming months, I would expect that to tick higher. And with that, let's take a look at the charts. And today we're going to take a look at gold, which this morning came within a whisker of record highs, falling just $2 or $3 shy of that previous record. Now, this is really interesting because we didn't get a full dovish pivot from the Federal Reserve. We just saw the dropping of language alluding to future rate hikes without any guarantees. And yet we've seen the yellow metal push back towards those record high levels. So the question is, if we are going to see some weakness in the data over the course of the next few months, if we are going to see the Fed start to accept interest rate cuts, does that mean that record highs are lying ahead? Or is this just a fact of the markets pricing in those rate cuts already, preempting what the Federal Reserve is going to do, and therefore pushing gold back towards those record levels? If we do take a look at the chart, you can see that there has been pretty decent momentum with gold over recent months, but that does appear to be easing now that we've gone back towards those record levels. You can see that the most recent high was made on weaker momentum, both on the stochastic, but also the MACD histogram and the MACD moving averages. That does not mean that the chart has necessarily peaked. We could still see another run at record highs. We could still see record highs in gold, but those momentum indicators do suggest that there isn't much momentum behind that, which could potentially lead to some profit taking and a correction in the yellow metal over the coming months if we don't see interest rate expectations decline further in line with the economic data, because markets are already pricing in a number of rate cuts, which is what the Fed has not yet at this point alluded to. Ultimately, this could also align with further turbulence within the banking sector, creating tighter credit conditions, which the Fed alluded to, and of course a weaker economy and lower inflation. From a technical perspective, though, that draws attention back towards those 1925 through 1950 levels. If we do see a move back towards those levels, you can see that that was support here back in February, March time, and again going from April into May. A break below that would suggest that we've seen a break of a neckline of a topping pattern of sorts. It's not really a head and shoulders or a double top or anything like that, but you can see that we have seen a number of repeated tests of that resistance around or near those record highs. And every time we've seen a pullback, it's at 1925 to 1950 zone where we have seen a rotation higher. So that would suggest that that is a significant level of support, especially given the fact that it would coincide with the 55, 89-day simple moving average bands, potentially signaling that we're not just seeing profit taking place, but we've moved into a correction pattern. If we see a break through those record highs around 2070, then there isn't any particular resistance above because we are now in record territory. So those big round numbers is where we would be looking, 2100 being the first notable level. And then we'll see how the markets trade. Momentum indicators are always key, I think, when we are trading around those record levels. Would momentum pick up with new record highs, or would we still continue to see divergences forming between price action and the momentum indicators, in this case, the stochastic and the MACD? What's clear is I think the next couple of months are going to be crucial as far as the US economy is concerned and US interest rates as a result. I think we're going to see a lot more evidence in the economic data that we are seeing weakening, that we are seeing softening inflation, that we are seeing tighter credit conditions. And all of this does not bode well as far as interest rate hikes are concerned and should feed the narrative that further interest rate cuts are going to be needed over the course of the rest of the year. It's just a question of at what point the Fed is going to accept that is the case and start signaling that cuts are in the offing.